Well, hello, ladies and gentlemen. Thank you for joining us in today's Good as Gold. It's been a big week for the gold market. We're going to go through the setups that we've been seeing. We're going to go through some of the macro factors that we've been seeing on the floors, looking at the fixed income market, because it really is the bond market once again that's driving us along where we're going. We're having a look at gold in various currencies and having a look at some of the macro thematics that are playing into this, because yeah, we've seen markets come alive, and we've certainly seen the gold price coming alive last sort of 24 hours. The question is has it got more juice to come? So I'm hoping everyone can see me. Just confirming that everyone can hear me okay and see me fine. Just waiting to make sure that that's all looking good. Just bear with me 2 seconds, please, everyone. Okay, perfect. Just put out a quick disclaimer. Everything I say today is general in nature, shouldn't be considered to be personal advice. Obviously, the thoughts I have today represent myself and obviously not my employer, Pepperstone. So please do not consider them to be personal in any kind of capacity whatsoever. All right, okay, cool. Let's crack on. So if you find yourself liking the video, smash the like button. Obviously, if you're going to put any comments, there's a comment section there. I'd love to hear from you. Let's get on the conversation. And yeah, going forward, if you've got any feedback, just drop us a message. You can come to me on Twitter at @ChrisWeston_PS, and we can go from there as well. But let's crack on with the gold market. Let's have a look at the technical. And I want to start really here with the big picture. Let's go big picture and then drill into the sort of the nitty gritty. And I've got the weekly chart of gold because I did see this coming up. Let's bring it onto the chart there, so you should be able to see that now. Okay, so what we've got is the weekly chart of gold, and we've got this kind of cup and handle in play. I mean, I didn't come up with this name, so don't sort of pull me up on this one. Where's the bit I'm looking for? There we go. Okay, so we've got this cup and handle in play. Long move up there. We've got this sort of body, the sort of depth of it, and if prices can break through this downtrend, then you've effectively got yourself this very, very large and very extended cup and handle pattern playing through. So some of the sort of pattern traders who are trading gold would like to see that one. That's an interesting one. So we wait for that to break, but that's usually quite a powerful sign. I'm not so much a pattern trader to myself. I know that it sort of represents the aggregation of flow, capital structure, and human behaviour at any one stage. But yeah, you can see that very much in play there. So yeah, we've seen a couple of clients sort of raise this to me and say, have you seen this cup and handle pattern on the weekly chart? It's quite a powerful situation if that breaks through, and I don't disagree whatsoever. If this sort of makes a move back up through 1843, then yeah, absolutely. The structure on this, if it can close above that level, would be very powerful indeed, and suggest that we could be going on to new all-time highs coming through in the gold market. But let's have a look more closer to home. Let's have a look at the daily chart, because we can remove this this channel, because one of the structures that we've been looking at, if we take a sort of a big picture view again before we go into sort of the nitty gritty, is this kind of head and shoulders pattern that you've got the shoulder here, head, and you've got the neckline coming in at 1833. Again, if that gets broken, then we'll probably go up to, we should be really going back up 19,000. I think the technical target is back up towards sort of 1940, that kind of region. So for people who are trading bigger picture, bigger time frames, there's a lot of people obviously looking at this 1833 level, not just because it's clearly resistance, clearly supply coming into the market, bigger picture, but it's also the neckline for this as well. So if that gets broken, we're going to be looking technically to target much higher levels. Shorter term, there's another little head and shoulders pattern if you're a pattern trader and you're looking at it. Some people just think patterns are a waste of time, and I'm sympathetic to both views. You've just got to be open-minded when it comes to trading. But we've got this kind of short-term head and shoulders pattern coming through. The neckline has broken, so that actually takes us into that neckline on the technical basis there. So what I'd really like to see personally is just a little bit of a recoil, a move back into 1777 before just to see how price behaves. Do we see that now really stepping in as support and being confirmed as support? Does the buyers step in and we actually see, a nice rejection off that level and then the buyers step back in? If that does, then I think, long positions for me are clearly warranted. And then it's going to be a question of trying to trail that to back up to this sort of 18.33 level. And again, then when we come to supply, I reckon we probably see a bit of wood to chop through those levels. But it is looking pretty constructive. I mean, technically, if you're a pattern trader, you'd be looking at this going right now and saying, I've traded the breakout. Do I want to wait for the retest? Obviously, price is true. You can take that into lower time frames and see how that acts. But generally speaking, after we're seeing a little bit of selling playing through after that very, very big bullish candle playing through, the question is, can we go back to 1777? Does that now confirm as support? And then we actually find the buyers stepping back in which case we'd look to at small positions in longs. When it comes back into these kind of levels and starts moving higher, my preference then would be looking to add to those trades and looking to cut back on any kind of move back below these lows of 1757. So, for me, this is firmly on the watch list as well. There's a number of other trades that have actually got on the watch list. I think I'm just going to sort of go in a bit of a segue before we come back to gold. Bitcoin, any of you crypto heads out there, have a look at the Bitcoin on the daily chart. 4 hours actually pretty good. But what we've seen is a breakout of these highs. Probably seen a few newbie clients newbie traders looking to buy that break. What's important now is the question is can we see that actually close on a daily basis, or is the situation going to be that this is going to be stuck back in the range? For me personally speaking, I like to wait for that because I think failed breakouts can actually be more powerful in some capacity than breakouts. But you really want to see a daily close above these levels and just see how price can act. If this goes, we could see a lot of momentum players coming through. That's an interesting one. I've just got a few other trades that are coming on the radar there. But going back to gold, it's been a good week for gold. I've got it looking here in US dollar terms. Actually, do you know what? If we are to go and look at gold in alternative currencies, the currency which everyone's been selling this week is the Japanese yen. The Japanese yen has been absolutely smashed from pillar to post. We're talking about a world of divergence and dispersions now playing between front-end yields as interest rate hikes get priced into rate curves, and you're seeing the Japanese yen obviously in Europe getting left behind. I don't think the first rate hike's now being priced in Japan until the latter stages of this decade. Whereas if we actually go into US, let's have a look at US pricing for rate hikes. I'm sort of getting off a beaten track here, but you can see Fed funds futures here, what's being priced into interest rate markets. And you can see for the end of next year that we got 42 basis points of hikes being priced in, 85 basis points of hikes being priced in, and then nearly 5 rate hikes being priced in by the end of 2024. You compare that there, and you can understand why the yen's been so badly smoked. You've got Japanese pension funds which have been moving money around. So what does that mean? Well, actually, let's have a look at gold in Japanese yen terms, because we offer XAU, JPY, and of course, if you're looking to go long, you want to be long in the weakest currency, and if you want to be short gold, you can actually max out that currency effect by being short in the strongest currency. And you can see here that that gold in Japanese yen terms has been on an absolute tear. Palladium actually in Japanese yen terms is up. Is up large, but you can see we're up 6% from those lows. So that's a really strong move in gold in Japanese yen terms. We've broken through this support level. Again, has the Japanese yen gone a bit too weak, too quickly, too fast? We're looking, the question that I'm facing and a lot of traders are facing, if you're trading on daily charts or 4-hour charts or those kind of time frames, is do I look to wait for a bit of a retest coming here, let off some of the heat, some of the steam coming out the gold market, and then look to re-establish itself and see how price behaves into this level if the buyers step in, look to continue on this bullish trend. Obviously, we're going to be watching what happens in dollar yen, because if you have a look at dollar yen, it's just, as I continue to say, I mean, it's been an absolute fire. CAD yen, Aussie yen, all the yen crosses have just been an absolute tear at the moment. So after this strong move up, we are consolidating. If this continues to push higher, then gold in Japanese yen is going to go higher, in my opinion. So that's the one where has been really, really strong. Of course, all our flow has been gold in US dollar terms, but in terms of the big move, it's been gold in Japanese yen terms on the long side, which has worked really well. Palladium's actually had a really, really strong move. We've seen this really nice base coming through. We're consolidating now, but what's that? It's a 12% rally or so. So yeah, you've clearly seen this big move up in palladium. So in terms of the actual precious metal complex, it's been gold, it's been palladium, silver has done really well. Now what we're looking at is one of the models which I think is really interesting for me when I came in this morning. And I saw that there was a very strong move that we've been seeing. And at a really basic level, what I like to look at is how far a price has moved in a very short space of time. Some people like to use Bollinger Bands, some people like to use Keltner Bands. This is a similar sort of statistical value situation. And what I've done is I've looked at gold prices relative to its 5-day moving average. I've used that very short term, and what you can see here is effectively a situation where the premium that gold has to its 5-day moving average got up to 1.7% yesterday. And I was thinking to myself, well, actually, this could be the point for mean reversion shorts, because it's just that elastic band's been pulled a little bit too far. Fine, if you're taking a longer term view, you could see price continue to move higher. But there is a point where it just gets a little bit extended in the short term, and you can get some good scalping situations to play through. What we see statistically, and this effectively this blue line is the average, then you've got 1, 2, 3 standard deviations either side of that. And what I like to see is a situation is where's the point where of statistical significance where over a larger data sample that we actually see prices move and we find the upside being capped. Now, of course, you go back to 2013, you go back to the pandemic, you go back to the GFC, you've got these kind of tail events that come through. But generally speaking, what we see on the 5-day moving average is around sort of 2%, around 2%, just under 2%. That the moves against the 5-day, when we see the price moving about a 2% premium to the 5-day, we see that being capped, and that becomes a level that we can look at short-term scalps, because that elastic band's been pulled too far. Hasn't seen it yet, but that's what I was looking at very, very closely indeed. But yeah, we're about 1%, so a little bit of heat coming out there as the 5-day moving average catches up. What we've also seen in terms of my sort of longer term model is how price is behaving relative to its medium term average, the 50-day moving average. And you can see here again, over the last, since I've got it since 2013, but I can go back to 2000 to create a bigger data sample. And you can see that the average price that it wears relative to its 50-day moving average is about 0.8%. So it usually has a bit of a premium to that, when we're pretty much neutral at the moment. What I like to see within in a sort of a longer term capacity is how price is behaving. And I do this for a lot of other currencies, where the dollar is, where the Aussie dollar is, and other markets as well. And we're pretty much neutral at the moment. So where it is to its, if you're talking about mean reverting markets, you can see that we're very much neutral. If we got above 4%, and certainly into sort of 6% above the 50-day moving average, that's where I'd suggest, that's where I'll be saying, guys, lighten up. We're a bit stretched at the moment. And also, when the price is about 6% below, I tend to see that being a level statistically where we can look at, statistical sort of mean reversion longs in that situation. So we're very, very neutral. The point here I'm trying to make is that when we came in, we'd seen this very explosive, impulsive move up, and it was starting to look a bit overcooked. In terms of the medium-term model, we're very, very neutral indeed at the moment. Okay, let's go and have a look at what's been driving this. Okay, so you've got a situation where inflation expectations have been moving higher. I'm going to go to my model, and again, I'm going to go back to the bond market, because it's absolutely key. I know we look at technicals, we look at flow, but for people out there who are fundamental traders and want to understand why gold's moving, we've got to look at the bond market, because yesterday we saw the US CPI numbers coming out. They were hot. Some of the transitory effects are coming out of the market. If you look at what we've been seeing. Eric, sorry, mate. I'm just. Is this similar to PMAR? I'm not actually sure what PMAR stands for, to be honest. We're going back to that sort of moving average model. Maybe you could elaborate PMAR. What does that acronym mean? I'm sorry, I'll understand if you could maybe shed a bit more light. I've not heard of PMAR before. I'll keep talking. If you want to maybe deabbreviate that would be awesome. Anyway, so going back to the bond market there, what we can see after the inflation numbers, so the transitory effects are that things like airline prices were down 6%. They will start pushing up again. Things like auto car prices were down. You know, that's subtracted from the CPI numbers. They'll start pushing back up again. Price moving average ratio and percentage. Yeah, I guess so. Absolutely. I've not used that one, Eric. There, I think if anyone who's watching this, price average, moving average ratio percentile. Yeah, I've not seen, I've not used that one. But yeah, I guess there'd be a very similar situation. You can use Bollinger Bands. Bollinger Bands look at look at two standard deviations relative to the 20-day moving average. And obviously, we know that within a normal distribution, that 68, or in the case of two standard deviations, 95% of those outcomes will be contained within those two bands. So effectively, what people do is if price breaks out there, we know that generally speaking, statistically, it comes back. I'm actually taking a slightly different approach and seeing how many times it's actually gone above that level and what percentage of times actually then the mean reversion players come through. So again, it's just like using a Bollinger Band probably, but actually back testing it and using it. So that's just a basic model that I use. I'm happy to write more about that if people find that quite interesting. But yeah, I guess I'd have to have a good look at the PMAR, Eric, just to get a sense. I've not used that indicator myself, so I can't talk too openly about that. But in terms of the inflation numbers that we've been seeing, there was probably something in there for the transitory camp. There was something in there for the non-transitory camp. But what we ultimately saw, if you look at the blue line here, this is the there's a million different market indicators you can use, but this is one indicator that people do use of expected inflation averaging in the US over the next 10 years. And you can see that blue line is at 2.5%. Now, if you look at the nominal treasury yield, which is the one everyone trades on, things like TradingView and various factors, this is the benchmark borrowing rate, 1.55. We can see actually after the back of that inflation expectations moved higher relative to nominal treasuries. Now, if inflation expectations are moving faster than an underlying asset, that's what we call the real returns. So what we can see is that real rates in the US, real 10-year treasury rates, which effectively is the handbrake or the real cost of capital, and it's the handbrake for valuations for duration assets. You can see that started to roll over. Now we had a situation where real rates were moving higher. That was very negative for the gold market because gold has no yield. So of course, if something becomes more attractive or less negative, should we say, then the reason gold with no yield becomes a less attractive place to be. So what we're seeing a situation is after the CPI numbers is that those real rates fell, and you could see that inflation expectations were moving higher than break-even rates. Now, if you have a look at the model, you can see that as real rates, this white line fell, it's kind of the line we were looking at there, you can see that the gold price has been moving up. Now, that relationship is pretty strong at the moment. If I have a look at, if I flip that upside down to show the relationship, you can see that there is it's not brilliant around these kind of July levels, but you can see that relationship has re-established itself. So it's a negative relationship that's playing through. But effectively what's happened... So effectively what's happened is as real rates and inflation-adjusted treasury yields have been moving lower, then we've seen a situation where the gold price has been moving higher. Okay, so that's been the big issue. So the question we've got to ask ourselves from now on, and this is where I'm coming with this, is what's going to drive inflation expectations further higher? And what's going to happen to the bond market? Because that's really going to be what's going to drive gold. And I think that we've got to continue to look at what's going on in the commodity markets, okay? So one thing we're looking at very closely is the oil price. Oil prices have had a strong move up, and break-even rates, inflation expectations have been following that very, very closely. The date that everyone's got to be watching out for is the 4th of November. That's when OPEC meet. If we're going to get a circuit breaker, it's going to come from two places. Probably the first one being US shale producers. Are they going to start pumping out more? So we're looking at the weekly oil inventory numbers. We're looking at the rig count. If they start pumping out more and the rig count increases, it's going to be a factor that shale gas prices are trying to go after market share. That will increase the perception of supply. Then, of course, OPEC, there's two factors which could happen with OPEC. The first one being that smaller nations might try and break free from the discipline and actually produce more than what was agreed, and you could see a fragmented OPEC, or they could come out and say the 400,000 barrel oil increase that we're seeing per month, we may actually take that up to 500,000 or even maybe higher. Citigroup were calling for 800,000. So that could increase the supply issue, and you could see oil prices, both, certainly for Brent and for WTI prices coming under pressure. Natural gas prices, which of course, 37% of US energy needs, 40% of Italian energy needs and European needs, had a really strong move up. We saw a lot of business in there. It's come back to the trend line, and we've seen buyers stepping back in. So that's really important as well. Can Vladimir Putin save the natural gas market and see that coming under pressure as well? So all of these factors with the supply side constraints are pushing up the inflation expectation elements. So if inflation expectations push higher as a result of these oil prices and natural gas prices going higher, that will be good for gold, in my opinion, because real rates are going to go lower in that situation. So that's definitely something we are watching. If energy prices coming under pressure, I think what we're going to see is a situation where real rates are going to go higher, and that's going to put pressure on the gold price in that situation. The question is which currency do you want to trade that in? So in terms of going back to where we are at the moment, things are looking pretty constructive. We really want to see a break of this downtrend of 1796. I think in that situation, the buyers are going to step in. What's going to cause that? It's going to continue to be lower real rates driven by higher inflation expectations. If we get a break of this downtrend, then we could. If there's a feasible chance over a week or two that we can get back into this 1832 level, where I expect to see good supply coming back into the market. That is the defining moment for the gold price, because of all this supply that's coming through, the technical head and shoulders inverse neckline that takes you back up to the all-time highs in gold. So a break of this downtrend. And I think we're realistically looking for that to move up. Do we trade that in US dollars or Japanese yen terms? Do we wait for a pullback into this level here and see how price reacts? That's my preferred situation. So really interesting scenario ahead for the gold price. Oil prices, natural gas, commodity prices, if they continue to go higher, it's going to be good for inflation expectations. That's going to push real rates lower. That's good for the gold market. We're going to see these technical levels being broken out. Have a look at retail sales later in the week in the US. If they're poor, that could be good for that could be bad for real rates, and again that could push the gold price higher as well. So a lot to look out for. We're obviously looking out for US earnings. We've got 15% of the US market S&P market cap next week, 46% the week after. Could see some volatility in equity markets. We've got a nice looking situation coming through Bitcoin. Can it close through there? Can we see a continuation of that move there? But in terms of gold in US dollar terms, our clients at the moment are quite nuanced, but it's really down to what's happening in real rates. If real rates are going to go lower, driven by inflation expectations and low nominal rates, the gold price is going to break through this downtrend, and it's going to push into 1834. If real rates do an about turn and start pushing higher again, then I'd expect gold prices to test that this former breakout range. How price reacts and behaves around there is, of course, what we're going to be trading there as well. So that's really it in a nutshell. It's really been about buying gold in Japanese yen terms, or buying any asset in Japanese yen terms. Can that trend continue? Big debate about that in itself. What happens in energy prices, I think, will have a big impact on the bond market, which will have a big impact on the gold market as well. So a lot to focus on. Things are looking pretty constructive at the moment. Let's see if it can continue. So if you've got any questions, do reach out. Leave your comments in the field. What would you like me to focus on more going forward? Is this the sort of right content for people on the gold market? And what is the sort of thing that people want to see going forward? So thank you for watching. If you do find yourself liking this, just hit the like button, and we really appreciate that. And if you've got any comments, reach out or reach out to me at Chris Weston _PS. Thanks for joining, everyone.